All right, everyone, welcome to Chapter 4. This is completing the accounting cycle. And Chapter 4 is going to be less challenging than Chapter 3 was, which I know you were all very sad about. But yes, Chapter 2 and Chapter 3 are really the hallmark and the foundation for this entire semester. They are the hardest chapters you will deal with. So please, if you had any difficulties with them, 2 and 3, focus on them. Revisit them, and my advice to everyone is always redo the homeworks. Okay, that's how to best prepare for my exams, is redo the homework from scratch. Don't look at the answers or the solutions. Start with no solutions. The answers are up on Web Campus for you to see at the end to make sure that you are doing it correctly, but make sure you understand how to do them. Honestly, the best way to prepare for my exams is redo the homework. And Chapter 2 and Chapter 3 are really tough ones. Chapter 4 is not that tough, but if you don't understand Chapter 2 and Chapter 3, 4 and everything after here will be incredibly difficult, if not impossible. So please focus on them and send me a message if you are having difficulties understanding them, as long as you've tried reworking them and seen the answers. But let's go ahead and get into Chapter 4. We're going to go through this slide. Kind of shows what we have already covered and what you have learned. And sorry that this box is slow moving, but it's going to show you. We started with 1. Right in Chapter 1, we learned how to analyze transactions. When a business transaction comes along, what's happening? Is an asset increasing? Is a liability increasing? So on and so forth. Step 2 is to create a journal entry based on what we analyze. Step 3 is to post that journal entry into the general ledger. Step 4 is creating a trial balance. Step 5, this is Chapter 3 stuff, is those difficult adjusting and accrual entries, right before we put out our financial statements. Step 6 is, of course, preparing the adjusted trial balance. So what does the trial balance look like after we adjust the accounts? And Step 7 is the final preparation of the financial statement so that we can tell the world exactly what our financial position is. The next 2 steps that we're going to learn are Chapter 4, which is 8, how to close our books and make closing entries, and 9, which is just to prepare a post-closing trial balance, which is really just after we close the temporary accounts, what does the trial balance look like? But Step 8 is the primary area where we're going to focus on, which is closing the temporary accounts. So first step is we want to identify the accounts that we're going to close. Next is we're going to record the journal entries and post those journal entries which close those temporary accounts, and then just prepare that post-closing trial balance. One of the things, let me back up here. One of the things that we're going to do is, of course, we're going to reset our revenue, expense, and our owner withdrawal accounts back to 0, right? We want them to be a 0 balance. Those are the temporary accounts, and we want them to all have a 0 balance. That is the only thing you need to remember. That is the key to closing entries. We are going to have a new account, and it's kind of a silly account. It's a real temporary account called Income Summary. And what I mean by real temporary is we're only going to use it for about 5 minutes. We're going to put some things in there, and then we're going to empty it out, and it also is going to be a 0 balance when we are done with it. You'll see what I mean as we get to it. This slide just kind of describes and summarizes what our temporary accounts are. Those are revenues, owner withdrawals, and expenses, and that new account that we're going to learn called Income Summary. Everything else is permanent. We do not do any closing entries or close them out. They are permanent. And the reason is we're never going to close out an asset, right? Not unless we sell the thing. And we're not going to close out a liability unless we pay off the debt. We're also not going to close off owner's capital unless we go out of business and or pay out an owner what we owe them. But every year, we are always going to close out our revenues, our expenses, and I think that's kind of self-explanatory. We've discussed it before, but it's because revenues and expenses describe, or income, right? Revenues minus expenses is our net income, describes how a company has performed over a period of time, usually a year or a month. So at the end of that period, at the end of the year, we already know how it's performed. What were the revenues and what were the expenses? Now we need to start recording the next year. So we need to start at a 0 balance, and we don't want to just continue on with the revenues from the year before. So The steps for recording closing entries are: first, close the credit balances in the revenue accounts, and we're going to close them out to income summary. What I mean by that is we're going to debit the revenue accounts for whatever amount is in them, whatever the balance is. If there's $10,000 credit balance in there, we're going to debit the revenue account for $10,000 so that we have a zero balance in our revenue account. And we're going to credit the income summary. So effectively, we're moving the balance from the revenue accounts into the income summary accounts. And I'll show you an example in just a bit. We're also going to do the exact same thing, but the opposite. We're going to close the debit balances in the expense accounts also to the income summary. So there's debit balances in expense accounts, right? Expense accounts are normal debit balance accounts. So whatever the debit balance is in each and every expense account, we are going to credit that amount to each and every expense account, and we will debit income summary. Once again, making all the balances in all the expense accounts zero and moving all those balances into this income summary account. And then we'll have the revenue and the expenses in this new account called income summary. And just for a second, right, it'll show us what our net income is or what our net loss is, whatever the balance is in that account. And next, we're going to close the income summary account. We just opened it and just moved these balances in there, right? Just a moment before, and now we're going to close it out. So whatever the net amount is, the revenues minus the expenses that are sitting in income summary, we're going to take that net amount and move it to owner's capital, which should make sense to us, right? This is Chapter 1 and Chapter 2 stuff. An owner's equity or an owner's capital increases with net income, right? Decreases when the company has a net loss, but increases when a company has net income. So, for example, let's say our company had $5,000 revenue and $5,000 of total expenses. We move the revenue into the income summary account, and we move the expenses into the income summary account. That leaves us with a net credit amount of $5,000, right? Our net income was $5,000. Well, that is the owner's $5,000 now. So at the end of the period, we move that $5,000 profit, net income, into the owner's equity account because we now owe our owner another $5,000. And that's why the owner invested in the company in the first place, right? I'll show you another example. We'll do real numbers in just a bit. The last step is, of course, to close owner withdrawals. If the owner withdrew any money this period, we also need to deduct that from his equity account, right? His equity would have been reduced by whatever amount he withdrew from our company. So let's take a look at the trial balance for the example company we've been working with and that's been in the chapter called Fast Forward, right? The consulting company. So this is its final trial balance here that we've got, debits and credits for every single account that this company uses. First thing we're going to do is we're going to look for the revenue accounts, right, which are right here. I'm going to highlight them for you. These are the revenue accounts. There's two of them because they do some consulting and they also rent a piece of their property out. So I've also put the general ledger accounts, the T accounts, so that you can see them here for both the rental accounts. So remember, here is what our step one is, right? First we identify the accounts, of course. We're going to go after the revenues, then the expenses, then we'll go after the withdrawals. Those are the only ones we're going to close. Withdrawals and everything below it. Nothing above it is going to be closed. Those are permanent accounts. So if I want to close my consulting revenue account, it's got a credit balance of $7,850. How do I make this balance zero? That's how I close it out. That's what I mean by closing it. How do I close this out? A credit balance of $7,850. How do I make it a zero balance? Yeah, I debit it for that exact same amount, $7,850. Likewise, how do I close out the rental revenue account if it's got $300 credit balance in it? Exactly. We debit it for $300 and make that a zero balance account as well. So let's take a look at what it looks like. We're going to be debiting the consulting revenue account for $7,850 and the rental revenue account for $300. Those are getting a debit. Let me back up so you can see what the balances were, right? They were credits. I need to debit them. The other part, the new part of this transaction that you're seeing for the first time is, of course, that new account called income summary. So we're going to credit the income summary account. And let's take a look at what the general ledger accounts will look like afterwards. Before The rent consulting revenue had $7,850 credit balance in it. We've now debited it for $7,850, leaving a zero balance. Did the same thing to rental revenue, leaving a zero balance here, and taken those totals, and now we have the total summary of all the revenue accounts in this income summary account, hence the name, right? Now, income, remember, is revenue minus expenses, so now we've got to add the expenses to this income summary account and at the same time close out those expense accounts. So let's take a look. Our expense accounts are highlighted here for you, right? Everything from depreciation expense all the way down to utilities expense, right? So these are all debit balances. So how do we get each of these to a zero balance? You guessed it. We are going to credit those accounts for the exact same amount. So we're going to credit them for whatever amount balance is in there, and whatever that total is going to be debited to the income summary account. In essence, we are changing all the expense accounts down to zero and taking the sum of all those expenses and summarizing them in the income summary account. And that's what we've done here, right? All the expense accounts are listed here. I'm showing you what the original balance or the ending balance was before we did these closing entries in black, but then I'm showing you the closing entries that we've posted here in red, and we've effectively moved those total income, or excuse me, total expenses into the debit column of the income summary. And now we've summarized all the revenues and all of the expenses in the income summary, and the net amount, if it is a credit, is net income. If it was on the debit side, meaning the expenses outweighed the revenues, we would have a net loss. But in our example, we do not. We have a net income. And you'll see all of our expense accounts now start with a zero balance. So we can start the new year with zero balances in all our revenue and expense accounts. Now the next step, the third step that we do, is we close that income summary account. Yeah, that account we were just working with. Let me back up so you see it. This account that we just created right here, where we just summarized the income, we're now going to close this out. And how do we close that? Well, the same way we closed everything else. If it's got a $3,785 credit balance in it, we are going to do a $3,785 debit to that account to get it to zero. Keep that in mind, folks. That's what I mean when I say close out an account. I want a zero balance. So let's go ahead and do that. And we want to close it to the capital account, right? Remember, that revenue, that $3,785 income, is now money that we owe to our owner. That is an increase in our owner's equity. So we got to take that from this account and move it into our owner's equity account. Here's what it looks like. $3,785 credit to the income summary account. That's how we close out that income summary account. And we move it into our owner's capital, and thereby increasing his equity, right? Previously, our owner had $30,000 equity, but the income that we created, that we earned this period, is now an increase in his equity and money that we owe him. So now the company owes him $33,785. His equity has increased. The last step is, of course, to close out the owner withdrawals. If he took some money out this period, we need to deduct that from his capital. Took out $200, same thing. When I say close out an account, I mean get it to a zero balance. If it has a $200 debit balance in it, how do I get it to a zero? You got it. $200 credit gets us there. And we're skipping the income summary account. Remember that, going straight to the owner capital. So we're crediting withdrawals to make it a zero balance and debiting the owner capital, reducing his equity. The income before increased it, but this reduces it, right? We went from $33,785 to $33,585.